What if I told you that the global silver market may be sitting on a massive imbalance, one that most people don't even realize exists? Imagine a system where hundreds of millions of ounces of silver are promised on paper, but only a fraction of that metal actually exists to be delivered. That situation is not just a small problem in the market, it could be the beginning of something much bigger. Many analysts believe we are approaching a moment where the difference between paper silver and real physical silver becomes impossible to ignore. And if that moment arrives, it could completely change how the silver market works. Welcome to Gold Silver Scope, the channel where we break down the most important developments in the gold and silver markets in a simple and clear way. Today, we are looking at something that could explain why silver has been acting so strangely in recent months, and why many experts believe the real story of silver is only just beginning. Let's start with a simple comparison that reveals the scale of the problem. In the silver futures market, there are tens of thousands of open contracts representing hundreds of millions of ounces of silver. Each of these contracts represents a claim on physical silver. In theory, the holder of those contracts could request delivery of real silver bars. But when we compare those paper claims to the actual silver stored in exchange vaults that is registered and available for delivery, the numbers look very different. For example, imagine there are contracts representing roughly 240 million ounces of silver, but the registered silver inventory available for delivery is only around 88 million ounces. That means the paper claims are almost 3 times larger than the metal that could actually be delivered. If even a portion of those contract holders suddenly demanded physical silver, the system would face a serious challenge. This situation highlights something that many people in the precious metals world have been talking about for years: the difference between paper silver and physical silver. Paper silver exists in the form of futures contracts, ETFs, and financial instruments that represent silver, but are not always backed one-to-one with real metal. As long as most investors simply trade the paper contracts and never ask for delivery, the system continues to operate smoothly. But the moment more participants begin asking for the physical metal, the pressure on the system increases. Think of it like a game of musical chairs. As long as the music is playing, everyone feels comfortable moving around the room. But when the music suddenly stops, everyone rushes to find a chair. If there are fewer chairs than players, some people are left standing. In the silver market, the chairs represent real physical silver, while the players represent paper claims. For decades, most traders never requested delivery. The majority of contracts were simply closed or rolled over into the next trading period. But in recent years, something interesting has started to happen. More buyers around the world appear to be demanding real metal, rather than just paper contracts. And this shift could have major consequences. Around the globe, governments and institutions are beginning to recognize how important silver has become in the modern economy. Silver is not just a precious metal used for coins or jewelry, it is also a critical industrial metal. It is essential in electronics, solar panels, advanced technology, and even many military applications. As technology continues to grow, demand for silver continues to increase. At the same time, finding new silver deposits is becoming more difficult. Many of the large and easily accessible deposits were discovered and mined decades ago. Today, mining companies often have to dig deeper and spend more money to find new resources. This creates a situation where demand keeps rising, while supply struggles to keep up. In fact, the global silver market has experienced multiple consecutive years where demand exceeded newly mined supply. When that happens year after year, it slowly tightens the physical market. And that tightening is exactly why many analysts believe the silver market is entering a very important phase. Because when physical supply becomes tighter, the difference between paper trading and real metal starts to matter much more. And that is where the story of silver becomes even more interesting. As the pressure in the physical silver market has been building, another major development has been happening inside the futures market. This is where many of the largest financial players trade silver contracts, and the rules of this market can sometimes have a powerful impact on price movements. Recently, something unusual happened that caught the attention of many market observers. The margin requirements for trading silver contracts were increased several times within a short period of time. For anyone unfamiliar with this concept, margin is the amount of money a trader must deposit in order to control a futures contract. For example, a standard silver futures contract represents about 5,000 ounces of silver, but traders do not need to pay the full value of that silver upfront. Instead, they deposit a smaller amount of money called margin to control that position. When margin requirements suddenly increase, traders must add more money to their accounts to keep their positions open. If they cannot add that money quickly enough, the exchange forces their positions to close. This is called a margin call. And when many traders receive margin calls at the same time, it can trigger massive selling. This appears to be exactly what happened. Over a short period of time, the margin required to hold a silver futures contract rose dramatically. Positions that once required around $15,000 to maintain suddenly required much more capital. For large institutional investors, this may not be a problem. But for smaller funds, private traders, or leveraged investors, these increases can become extremely expensive. As the margin requirements kept rising, many traders were forced to liquidate their positions. When those positions were closed, the selling pressure increased. And when selling pressure increases quickly, prices can fall sharply. This is how a cascading effect begins. Selling causes prices to fall. Falling prices trigger more margin calls. Those margin calls force even more selling, and the cycle continues. Within a short period of time, a huge portion of open interest in silver futures contracts disappeared. In other words, many traders exited their positions completely. Millions of ounces worth of paper silver contracts simply vanished from the market. To an outside observer, it might look like investors suddenly lost interest in silver. But the deeper story is that the cost of holding those positions became too high for many participants. This type of event is sometimes described as shaking the tree. When leverage is high in a market, sudden changes in margin requirements can remove weaker hands and force them out of their positions. Once those leveraged traders exit, the market is left mostly with stronger players who have deeper capital and longer investment horizons. And this is where another interesting development appears. While many leveraged traders were being forced to sell their contracts, large institutional players were quietly adjusting their positions. Some major banks and financial institutions appear to have significantly reduced their previous short positions in silver. A short position means betting that the price of silver will fall. When those positions are closed, it often means the institution either expects prices to rise in the future or wants to reduce risk. In other words, while many smaller traders were forced out of the market during the price drop, some of the largest players were positioning themselves very differently. At the same time, large quantities of physical silver have continued to move through global exchanges. Significant deliveries of silver bars have been requested, and physical metal has been leaving exchange vaults. This raises an important question. Who is taking delivery of this metal? Large deliveries require serious capital. The buyers involved in these transactions are not small retail investors. They are likely large institutions, governments, central banks, or major industrial buyers who need physical silver for long-term use. And unlike leveraged traders, these buyers do not care about short-term price swings or margin requirements. They are purchasing the metal outright. When buyers operate at that level, they simply write a check and take the metal. That is why some analysts believe we may be witnessing a quiet transfer of silver from weaker speculative hands into stronger long-term holders. And if that interpretation is correct, it could be setting the stage for a very important shift in the silver market. Because once the physical metal moves into strong hands that are not interested in selling, the available supply in the open market becomes even tighter. And when supply becomes tighter, while demand continues growing, markets eventually respond. But the biggest developments in the global silver race may still be ahead. Now, when we step back and look at the bigger picture, it becomes clear that the silver market may be entering a completely new phase. For many years, the price of silver has been influenced heavily by paper trading in futures markets. In those markets, large amounts of silver can be traded without the metal ever changing hands. As long as most participants are simply speculating on price movements, the system can continue to operate without major stress. But when more buyers begin demanding physical delivery, the situation changes. In recent years, physical demand for silver has been increasing across multiple sectors of the global economy. Silver is not only a precious metal used for investment, it is also one of the most important industrial metals in the modern world. It plays a crucial role in electronics, solar energy technology, electric vehicles, advanced computing systems, and many other industries that are expanding rapidly. At the same time, the supply side of the silver market faces several challenges. Many of the richest silver deposits were discovered decades ago and have already been heavily mined. Today, new discoveries are becoming harder and more expensive to develop. This means mining companies must spend more time and resources to produce the same amount of metal. Another important factor is that a large portion of global silver production does not actually come from primary silver mines. Instead, most silver is produced as a byproduct when companies mine other metals such as copper, lead, and zinc. Because of this, silver production is often dependent on the economics of those other metals rather than silver itself. This creates a unique supply dynamic. Even if silver demand rises sharply, production cannot always increase quickly because it depends on mining operations focused on other resources. Meanwhile, governments and industries around the world are beginning to recognize how strategically important silver has become. As technology advances and global competition increases, access to critical metals is becoming more important for national economies and industrial growth. Some countries are now focusing on securing their own supplies of important minerals, including silver. When nations begin prioritizing domestic resources and limiting exports of strategic materials, global supply can tighten even further. All of these factors together create what many analysts describe as a global race for physical silver. On one side, there is growing industrial demand from emerging technologies. On another side, there is increasing investment demand as people look for ways to protect their wealth during times of economic uncertainty. And on the supply side, production growth remains limited. When these forces meet, markets eventually move toward what economists call real price discovery. This is the point where the true value of a commodity becomes clearer because the physical supply and demand forces begin to dominate the market. If more participants continue requesting physical delivery instead of simply trading paper contracts, the structure of the silver market could gradually shift toward that real price discovery. And this is exactly why many long-term investors continue to pay close attention to silver. Because history has shown that when supply shortages meet rising demand, commodities can experience powerful price movements. Of course, no market moves in a straight line. Prices can rise quickly, fall suddenly, and move sideways for long periods of time. But over the long term, the fundamental forces of supply and demand always play the most important role. For silver, those fundamentals are becoming increasingly interesting. The world is using more silver than ever before, while new supply remains limited and physical demand continues to grow. When large institutions, industries, and investors begin competing for the same limited resource, the balance of the market can change very quickly. That is why many analysts believe silver may still be one of the most undervalued assets in the global financial system today. If you found this analysis helpful and want to stay updated on the latest developments in the gold and silver markets, make sure you subscribe to Gold Silver Scope. On this channel, we break down complex market events into simple explanations so you can better understand what is really happening in the precious metals world. And if you enjoy learning about gold, silver, and the future of the global economy, don't forget to like the video and share it with others who are interested in these markets.